Guys, in this video I want to show you the anatomy of a reversal trade, and it's unfolding right now. And I also show you a couple of examples of yesterday's trading day which were more than obvious. But for now, let's take a look at the current market situation. What do we have here? We see the market started off right here at this level at the 915s, 916 level. All right. It then shot up to this level. We traded some contracts here, quite a bit actually. And then we came back all this way quite aggressively, right? So what do we have here? We have a market situation where there are potentials for some very nice reversal trades, potentially here, and obviously below the slow, potentially here. And in this video, I want to show you exactly how you can trade these trades and make money off of them by understanding the anatomy of a reversal trade. Now, what does anatomy mean? It's basically the structure, the puzzle. So once you know every piece to the puzzle and you can put them together, then predicting these trades down here for a very nice reversal trade all the way up here will become quite easy, hopefully, for you. And there's a couple of things that we need to go through. Every piece to the puzzle will make sense to you. And once you understand every single piece, then you can move forward and obviously piece them all together at some point. So for now, let's get right into it. The first piece to the puzzle is the volume profile, okay? The volume profile is what you see here on the right-hand side, all right? Left-hand side. You also see this basically for every single day because it's the only indicator that I use because it's very reliable and it's based on the truth. Now, what do I mean by the truth? You can see this. This right here is a volume profile. This right here is a volume profile. And every single volume profile shows you how many contracts were traded at every single price. So for example, at the 800s, we had quite a few contracts being traded on this day right here. So here, and once more here. Quite a few contracts. Now, if you compare this high volume node to a low volume node, for example, up here, then we see we had very little contracts being traded on this price level. Same here. Now, what does it mean? Basically, high volume nodes mean price acceptance, and low volume nodes, so up here and down here, mean price rejection. Or in other words, this right here is expensive and this down here is cheap. And this in the middle is considered fair. Okay, so if you want to make money trading cars, for example, what you'd want to do is you want to buy a car for a very good price and you want to sell it on the internet or wherever for a fair or for an expensive price. However, your advantage pretty much disappears above the fair market price. So once you go into the premium level, your advantage is pretty much gone. Sure, there might be some idiot who buys a car for 2,000 more than it's actually worth, the fair price. However, that's not really likely going to happen all the time. So your best bet is obviously buy it cheap and sell it at a fair or expensive price if the market conditions are right. Now, when it comes to the volume profile, there's quite a few structures that we need to take a look at, okay? So the market profile, and we can see this right now, for example, has certain shapes. And I made a video about those volume profile shapes before. But usually what you want to see is, for example, today, if you just take a look at the volume profile, we have this line obviously right here. And now I just follow this line right here. So right here and right here. I'm just following this. And how does it look like? It looks like a capital B, right? And a capital B basically means that the market is accepting both of these price levels. It accepts these levels down here because we printed quite a few. We actually had quite a few contracts being traded here, but we also accept these levels up here because, as you can see, the market is accepting these price levels. Otherwise, we wouldn't have all of these contracts being traded here at these price levels. That means we have an advantage here going short, and we have an advantage here going long. Okay, guys? That's the basic gist of it in terms of a capital B profile. Now, sometimes what happens is that the market goes from down here, like you see here. This was a very small B, most likely, or even a D volume profile. The market breaks out. Then it's trading quite a few contracts here. Very beautiful capital B here. Now it's accepting these higher prices. And sometimes it happens that the market now breaks out to the upside, because obviously we went from down here. Now we're accepting higher prices. And sometimes things happen where the market's even accepting higher prices than this. But for now, let's take a look at what we currently have. We can see that we have a capital B volume profile. That means longs here, shorts there. We have the same story, for example, yesterday, which was a bit uglier, to be fair. However, this, if you take a look at it, is more like a D volume profile, kind of. It's a bit more difficult. However, you can see that here you had an advantage to the upside, meaning trading longs, and here going short. So this would have been a very nice trade, and this one would have been a very quick scalp, to be fair. However, I guess this would have worked out once, and then it didn't work out one more time. Okay, so that is a capital D volume profile. And I'm not going through all of them right now, just so you know. You either want to trade a reversal trade. This is very important now. You only want to trade reversal trades in capital D volume profiles. So it's a balanced day, or a capital B market condition, but only if it looks like it currently does. Okay, those are the only market conditions where you do want to trade a reversal trade. Okay, if you have a trend day, meaning the market is just going up, 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 up the entire time, then you don't want to go for a reversal trade. You don't want to do this because there's a very high probability that you don't know where to look for this level right here, where things become a bit more difficult for the market to shoot up even further. I can do this, but I've been trading the markets for a very long time. I know when the market is most likely going to reverse from this level. But if you try this as a beginner, the market is most likely just going to keep going up, and you will get stopped out right here for a loss. And then you think, oh, all of this doesn't work, even though it does, even though you just didn't know where to look for a nice trade. Okay, so those are the market conditions in terms of the volume profile. Okay, right now you can see we are breaking out of this low right here, but no worries, we can come back. And once we come back to this area, then we have a very nice reversal trade. But I will show you some key things to consider as well, so that these things right here don't happen to you, that you don't get stopped out on a very promising trade actually. Okay, so that is the volume profile. That is the first piece to the puzzle. The second piece to the puzzle is called auction quality, guys. Auction quality. So if you were a retail trader, then you probably know resistance and support, right? You've heard of these terms, right? Now, the question is, how does the market go to these levels? Does it go there with good auction quality, or does it go there with bad auction quality? It's only two things, good or bad. And for that, we use a software tool called Bookmap. Okay, Bookmap basically tells us when there is good auction quality and when there's bad auction quality. And take a look at this right now. This right here is considered extremely bad auction quality. Why? Because compare this move where we had buying green bubbles and selling red bubbles, buying and selling, buying and selling, buying and selling the whole time, to this move where there was only selling and the market shot down in a matter of seconds. This is bad auction quality. This is good auction quality. Okay, so if we combine this, for example, we have a D volume profile. You know your advantages here to the longs and here shorts, always just a reversal. And you see the market is going into your level of interest with bad auction quality. That is your second piece of the puzzle. So if you see this happen, and this is your level of interest, then there's already a pretty high chance that the market is going to reverse off of this level. Third piece of the puzzle is buying being rewarded or is selling being rewarded? So for example, if we move down to, and I'm going to make this a little bit bigger for you guys here. If we move right here to the downside of our volume profile, if we go there, you want to see that once the market reaches your level of interest, so for example, we trade back and forth, and now we are here at our level of interest, okay? We go there with bad auction quality, volume profile is still intact, meaning we already have two confluences that this trade might work out. And now, before you enter a trade, you want to see that the market is rewarding buying, meaning, let's take a look at this. We went here with bad auction quality, right? Now, buying came in. You can see all of these green bubbles. But what happened? The market barely moved up. It barely moved up. And then some selling came in and the market just completely went down. So who's being rewarded right now? Buying or selling? In this case, selling is still being rewarded. So all of this buying is basically doing nothing. And you don't want to see this because that means that buyers are not in control. Sellers are still in control of this price level. So if you see this, then you can wait. You don't go in for a trade because even though you had two confluences, a third one is not right now in place. And that means we don't want to trade, okay? If this happens and you have three confluences, perfect. Then you go for a fourth one and potentially even a fifth one. The fourth confluence is liquidity. Now, what is liquidity? Think of it this way. You see in Bookmap here, which is just another way of showing the charts, okay? So what you see here is basically just a different visualization of what you can see right here, okay? Now, what do we see here? We obviously have our charts, but we also have these levels here. And that is liquidity, okay? So think of it as an auction. You have people that are willing to buy at this price level down here. The market went down, 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 down. And down here, someone said, well, at this level, I'm willing to buy because this is considered cheap for that buyer in this case. Cool. Okay. Now we see there's a buyer. Now at these price levels, above the current price, these are sellers, okay? Because they say, hey, this right now is pretty cheap. I don't want to sell at those cheap prices. I want to sell up here because those are fair or expensive prices, which is obviously better for a seller because he gets more bang for his buck. Cool. Now that we know that, we need to understand one thing. Liquidity acts like a magnet to the market, especially long-term liquidity. There's a difference between short-term liquidity, this, potentially even this, and longer-term liquidity. Look how long this was in the market. Look how long this was in the market. Beautiful. And you can also see what is the shift in liquidity. So for example, is liquidity moving up or is liquidity moving down? Because liquidity always moves. It's never static, okay? So sometimes you see this, for example, where there was previous liquidity at this level at the 23,910s. And then this guy said, well, the market is going down. I might have to go a little bit lower and get less money for my contracts here. So he moved his contracts down to the 09s, okay? That is what happens. So liquidity shifts sometimes. And what you'd like to see is that if you are at your level of interest, okay, you're at your level of interest right here, for example, right there. This is our level of interest, okay? What you'd like to see for a reversal trade to the upside is that liquidity is there. It's basically either A, moving up, so liquidity is shifting from the downside to the upside, and you want to see liquidity fading out below, meaning there is little to no liquidity below your level of interest, okay? You can see this, for example, every time we move down, there was liquidity very close by to the market all the time. And now that we went to this level, for the very first time, there was this area of darkness where there was no liquidity at all. And then we see our fifth piece to the puzzle, which is an absorption. Now, what is an absorption, guys? Look at all of these bubbles. Look at all of these bubbles here. And by the way, is buying or selling being rewarded here at this level? Buying. You see some buying coming in, market goes up. More buying comes in, market goes up. Buying is being rewarded. Compare this with this huge bubble down here. Lots of selling came in. However, there was potentially one market participant, a big player, is what they call them. Banks, hedge funds, doesn't really matter what it is, who basically said, hey, no matter how much you want to sell to me, I'm going to buy up all of these contracts that are being sold to me right here. Because he believes this down here, which is obviously down here, is a cheap price. And he wants to get his hands on as many contracts as possible as long as the price is cheap. That is an absorption. It can happen to the upside, but also to the downside. So right here, sellers were being absorbed, but you can also see the exact same. The color would just be green, a green big bubble, where buyers are being absorbed, which would obviously be a bearish signal. Okay. And just like that, you have already five confluences that can dictate, should you go in for a reversal trade or should you not? And just look at this. We had this huge move down, very bad auction quality most likely. And then we had so many confluences speaking for a reversal trade. We went through all of them right now. And there's one more that I'd like to introduce you guys, which is a combination of high volume nodes and the volume profile. So for example, what usually likes to happen is that the market turns around at key levels, either in price action or volume profile. So for example, you can see right here that at this price level where the market suddenly turned around, we had this huge level of rejection, right? Once here and twice here. Third time right here. And look where the market suddenly reacted from. Right here. Beautiful, beautiful, beautiful. But you can also combine this usually with the volume profile. So every time you see high volume nodes from previous days here, obviously also here, and right now we're at the all-time highs, so it's a bit more difficult to be fair. But usually you can also mark this price level here where we had this high volume node where we actually are very close to. So this level right here, that is where things become very interesting for you, right? That is where things become very, very interesting. And now we see, wait, the volume profile is pretty good. It's still intact. Now we have 1, 2, 3, 4, 5 influences or confluences, I'm sorry, speaking for our trade. Bad auction quality, buying is being rewarded. We see a shift in liquidity, no more liquidity down here. We see an absorption and all of these things. We see all of them. And then we go in for a reversal trade. And this can be, I would say, to be fair, that you get in above this level. So once you see a change in market structure, which you can also mean or use as a sixth or seventh, however many confluences we have already. Once you see a change in market structure, meaning lower highs and lower lows, turning into higher highs and higher lows. Once we see this shift here, this break of this level, then you can get in. So you get in at the 94s, okay? And now you want to see where should you exit this trade. And for that, we take a look. And let's actually do this together. Well, at the 94s, we get in right here. What do we see at this moment? We see at this moment, that is our entry, right? We see that we have a bunch of liquidity up here. We had a bunch of liquidity here and here. So at these price levels, that is where it gets interesting. Liquidity, previous liquidity, so current liquidity, previous liquidity, and previous liquidity. That is where things become interesting. Now, you should get out if you go into either one of these levels with the exact same criteria for a reversal trade. Bad auction quality, potentially buying not being rewarded anymore, an absorption, all of these things. If you see them just the other way around now, get out because your trade idea is not valid. And look at this. Look at this. Where do we go? Right to this level of liquidity. Right to this level of liquidity. And I want to actually give you one more criteria. And obviously, these are a bunch of criteria right now, a bunch of them. However, this was just very obvious right now. Take a look at this level right here. What is happening? You don't see any bubbles, right? You don't see any bubbles. Compare this with the amount of bubbles that you see down here, or here, or here. You see this because this right here is called an exhaustion. You see the market is exhausting. We went from all of this buying pressure to now the market taking a breather, the market resting a little bit. And if you see this at a level of interest for you, that usually means, in combination with bad auction quality, liquidity, and all of that good stuff, that hey, the market could potentially turn around here one more time. And just like that, you go in at the 94s, you get out potentially at the 99s or at the 900s. And that's a 24 tick profit? More than enough. If you enter with a couple of contracts, more than enough. And this right here would have been a 1-to-1 risk-reward trade ratio. So you get in here, obviously your stop loss should be right there, your take profit is right here, and then you just see what happens. You either get out all the way, or you basically scale out your first contracts here and see where the market takes you, and then you would obviously move those other contracts that you still might have here, you would move them to break even and see what happens. This right here would have then been a break even trade, and now we get back to this level of interest. We get back there, and what do we see? Still some more absorption and exhaustion. Like auction quality was okay, not the best, not the worst. However, we see a shift in liquidity downwards. We have no liquidity above right now, right? We have quite a bit of liquidity down here. So would I enter again right now? Probably not, guys. Probably not. Because the current market state is not going for our advantage. Okay? It's not. And just like this now, you have a checklist. 1, 2, 3, 4, 5. Certain pieces of the puzzle. Where you can now think, what is going on? What is going on? What is happening in the marketplace? And you can look at this, piece them all together, and at some point, your puzzle is just super, super beautiful because you know exactly this is the right moment for me to now enter in a reversal trade. And when it comes to breakout trades, that is a whole nother video, which we can look at another day. But for now, these are the criteria for entering a reversal trade. This is the anatomy of a reversal trade, broken down in a very few key principles. If you have any questions about this, let me know in the comments down below. Otherwise, like this video, subscribe to the channel, and I'll see you in the next one. Bye-bye.